Hi, my name is Nicole, and this video is about synthetic long stock. What if I told you that you could trade a stock like you own it without actually buying a single share? With the right options combo, you can create a position that mirrors long stock exposure, but with a fraction of the capital. Learn how traders use this strategy to gain exposure with leverage, when it works best, and what risks to watch out for. Topics covered in this video include a definition of synthetic long stock, how the strategy works. We review risk-reward profiles, including max gain, max loss, and break-even points. We talk about the pros and cons of synthetic stock positions, as well as best use cases. So what is synthetic long stock? Synthetic long stock is an option strategy that replicates the profit and loss characteristics of owning 100 shares of stock by using only options contracts. Here's how it works. You buy a call option and simultaneously sell a put option at the same strike price and the same expiration. So let's hop into the tastytrade platform here. To demonstrate what I just described, I have SPY pulled up. And I first want to take a look at buying 100 shares of SPY. You can see here that the delta is going to be 100. And the max loss on the position is going to be the cost of the shares, which is $62,407. And when we take a look at the P&L graph, we can see that we'd be buying 100 shares at $624.03, and profit would be unlimited to the upside, and losses would be limited to the amount paid for the shares. Let's contrast this with the synthetic long stock, where I sell 1/625 put and buy 1/625 call in the September 19th, 2025 expiration. And we can see here that the delta on the position is close to 100 and the max loss is $62,818. So while the max loss isn't exact, it is very, very close to the long stock max loss. And you can see here that the profit and loss diagram looks exactly the same as what it would look like if we purchased 100 shares of SPY. Let's talk about break-evens and profit and loss. Break-even is simple to calculate. If you paid a net debit, your break-even is equal to the strike price plus the net debit. And if you received a net credit, your break-even is equal to the strike price minus the credit received. The profit and loss characteristics are identical to owning stock. You get dollar-for-dollar gains above the break-even with unlimited upside potential, and you get dollar-for-dollar losses below the break-even with substantial downside risk. There are some important differences between synthetic long stock and actually owning shares. First, capital requirements. When using this strategy in a margin account, traders typically require much less capital to open a synthetic long stock position versus buying shares outright. Next, time limitation. Unlike stock ownership, this strategy has an expiration date. You're working within the term of the options. Next, assignment risk. You can be assigned on the short put at any time, although this is rare. And finally, you have no ownership rights. So with a synthetic long stock position, you don't get to vote or receive dividends. Now let's break down the capital requirements in detail, because this is really the primary advantage of synthetic long stock. Let's take a look at what the capital requirements would be for us to purchase 100 shares of SPY in a regular margin account. You can see here that it would reduce our buying power by $31,241.50, which is approximately 50% of the total cost for purchasing 100 shares of SPY at $624 per share. Now let's contrast that with the synthetic long position here, where we sell a put at $625 and buy a call at $625. And we can see that the buying power effect is quite a bit less at $14,318.30, which is a little over 20% of what the total cost would be to purchase 100 shares of SPY at $624 per share, and it's about 50% of the buying power required to purchase 100 shares of SPY on margin. So you can see there that that's quite a dramatic effect, and I'm moving out to further dated expirations just to see how this might affect the buying power reduction. And as you can see, as we move further out in time, if you look at that buying power effect, it is creeping up a little bit. So the further out in time you move, the higher the buying power effect goes. And that makes sense because the more time you have, the more things can go wrong, so your risk would be increased. And that's reflected in what the brokerage accounts require for buying power. Let's take a look at a different symbol, NVIDIA. And we're doing this because margin requirements do differ based on individual stocks and ETFs. So let's take a look at the buying power requirement for purchasing 100 shares of NVIDIA at $171.34. And we can see that the buying power effect would be $8,567. So not too bad, roughly 50% of the purchase price. And now let's take a look at what kind of margin relief we'd get if we put on a synthetic long stock position. And you can see here that the buying power effect would be a few $1,000s less than purchasing 100 shares. Buying power effect would come in at $6,211.50 to put that trade on. So it's a little bit different than SPY. And you'd want to weigh that in your decision on what strategy to use based on the margin requirements for the individual stocks. Now let's look at Apple. The buying power effect to purchase 100 shares of Apple is about $10,587, which is roughly 50% of what it would cost to purchase 100 shares outright in a regular account. And now let's contrast that with a synthetic long stock position. And we can see here that the buying power effect is about half of what it would cost to purchase the 100 shares on margin. You'd only have to put up about 20% in that case. Now let's look at a very volatile stock, MSTR. So in order to purchase 100 shares of MSTR, we can see that the buying power requirement is quite a bit higher, well over 50%, at $33,214. And let's contrast that with the synthetic long stock. And you can see that the buying power effect is only $22,038. So cheaper than to purchase the 100 shares from a margin standpoint, but definitely much more expensive when comparing the margin requirements for something like Apple or SPY. Margin requirements differ based on the stock being traded, primarily due to varying levels of risk associated with different stocks. Factors like a stock's price, volatility, and outstanding shares influence the margin requirement, with more volatile stocks generally requiring higher margin. By adjusting margin requirements based on perceived risk of each stock, brokers can manage their own risk exposure. Now let's talk about volatility and time decay. Here's an interesting aspect of synthetic long stock. Volatility isn't a major consideration. Since you're both long and short an option with the same expiration date, changes in implied volatility should roughly offset each other. And similarly, time decay effects will roughly offset each other since you're long one option and short another with the same characteristics. And at the bottom of the screen here, I have a screenshot of the very same SPY synthetic long stock combo that we analyzed in tastytrade, where I highlight the Greeks. The delta is 100, the gamma is negligible at negative 0.04, theta comes in at only negative 5.41, and vega is negligible as well at 0.20. Now let's talk about assignment and expiration risks. Critical risks to understand. Early assignment. You can be assigned on the short put at any time, especially if it goes deep in the money. However, this is rare, but can happen. And actually, when it does happen, it's probably beneficial for you if you decide to work yourself out of the position. Expiration risk. Be aware of your position's expiration date and manage accordingly. And special events. Be aware of corporate actions like mergers, takeovers, or special dividends, which can change typical exercise patterns. So I would not recommend using synthetic long stock in these special situations. Let's talk about when to use synthetic long stock. Well, best use is when you want stock exposure with less capital. That's the primary benefit of this strategy. You also need to be bullish on the stock in the short term. When to avoid this? Well, if you're planning a long-term buy and hold strategy, you want to avoid this. If you're bearish on the stock, this would not be the strategy for you. Finally, if the underlying lacks liquidity. So if the bid-ask spreads for the options are wide, you want to stay away from synthetic long stock strategies. Now let's talk about some key takeaways. Here are the essential points about synthetic long stock that you want to remember. Construction. Synthetic long stock equals long call plus short put at the same strike price and same expiration. The risk profiles are nearly identical to owning 100 shares, and it's highly capital efficient, requiring less upfront capital to initiate a position. It is time limited as the strategy expires with the options, and there is assignment risk. Synthetic long stock is just the first of 6 essential synthetic positions. In the next video, we'll cover synthetic long calls and when they might be preferable to actually buying call options. If you found this helpful, subscribe and hit the notification bell for the rest of the series. As always, thanks for watching, and I'll see you in the next video.